Erik Britton is director of Fathom Financial Consulting. They've actually just put out a report warning that the whole Eurozone is at risk.
Yeah.
Why?
Because there's a domino effect in play, essentially. If Greece defaults or approaches a position where there has to be a haircut of, say, 70% to make Greek debt sustainable, it doesn't stop there. That means the banking sector in other European countries are insolvent, need to be recapitalised by the sovereign, and that pushes them potentially tips the balance for them into default as well. So Greece going potentially unravels the whole thing.
And so, well, let's just take a look at that some more, because you have actually quantified the risk if this contagion takes place, if it does actually unfold, if Greece defaults. And just take a look at the chart from your latest report, and you're saying that Greece is almost 100% likely to default based on CDS prices as they are now.
And not just CDS prices. Markets are basically pricing in a Greek default.
Okay, well, but then beyond that, you can see here in this chart that you've got Portugal's risk of default once Greece goes, and then, you know, once Ireland goes, Portugal goes. So just for our viewers, you can see there, it's sort of a chart showing the knock-on impact, the ripple effect, if you like, from Greece to Portugal to Ireland to Spain to Italy and France at the end there. So just talk us through this domino effect.
So think of each of those columns as a domino, right? The one at the left is going to topple. It's going to bump into the Portuguese domino, which will more than likely fall as a result, all the way down until we get to France, which will hang in the balance.
Okay.
And France is core AAA rated Eurozone economy.
I mean, as you quite rightly point out, it's core, it's AAA, and, you know, a lot of analysts and economists are saying that a default for economies like France and Italy, absolutely inconceivable, because when you look at the fundamentals, the speculative attacks in the markets are simply not justified. Their fiscal position isn't too bad.
Well, France, that's possibly true. That's why France is still only in the balance at the end of that. Italy's fiscal position is very bad. It's not that its deficit is bad, but its debt levels are extremely high. They always have been. But now that we're in a situation where there's a market sentiment that the Euro project might be about to unravel, eyes are turning towards Italy and starting to worry about that high.
But I suppose because of the size of the Italian economy, there are measures that can be taken to extricate itself from the crisis, if you like. So there is some potential for growth there if the right sort of measures are in place.
Well, possibly. So what measures, right? So Italy is in a fixed currency union, so it can't do anything with monetary policy. Fiscal policy, it's tightening fiscal policy in the teeth of what looks like a global, at least slow growth period, maybe a recession. That medicine delivers much lower growth for Italy. It's like being in the gold standard and tightening.
So you don't think measures like, you know, raising the retirement age, easing labour laws, cutting back on regional spending, government spending in general in both Italy and France will make much difference at the end of the day?
Well, if you cut back on government spending, it will improve your deficit. Does it improve growth in the short term? No, it probably makes it worse. And you're already in a low growth environment. The risks are there. They are pronounced. The hope is that the European politicians understand that, understand how this process can unravel, understand that you can't just cauterize the Greek problem and close it off and then we're done. It's going to...
So you're saying that essentially it's going to be very difficult to ring-fence the problem.
Yes.
But again, you know, there are many who say, look, it will simply not be allowed to happen. They will continue pumping money, they will continue with bailouts, whether it's through the EFSF or the ESM or some other mechanism, but it will not be allowed to happen because the economic cost of failure is too great.
Well, it depends what you count as constituting failure. Well, I think failure would be the euro imploding, a default of the euro, and the euro unravelling as a project. I don't think a default of Greece within the euro is failure. In fact, I think that's absolutely essential. Greece, Ireland and Portugal too. And the issue is, it's no good bailing them out if that involves just lending them more money because they've already borrowed too much. What you have to do is write off the bad debt that you've already lent to them. And the sooner we get to that outcome, the better it is for everyone.
All right. Erik Britton, Director of Fathom Financial Consulting. Good to get your views, your latest report.